Why is EUR USD dropping today? Because the market is repricing the Fed ECB spread, and the latest news flow is accelerating a short squeeze in the dollar. EUR USD forecast today hinges entirely on whether 1.1349 holds or gets liquidated. Euro to US dollar just ripped through 1.14 as if it wasn't even there. And right now, the entire retail crowd is doing exactly what you'd expect. They're piling into shorts, chasing momentum, certain this thing is going straight to 1.12. But they're all looking at the same level, and that's the problem. There is one danger zone and one hidden opportunity right now. I'll show you both. Because while everyone's staring at the freefall, the real money is setting a trap exactly where liquidity will get grabbed. Stay to the end. I'm giving you 3 exact levels you can trade today, including a sniper entry that most people will miss and an aggressive play that could catch the reversal. Here's your instant session bias. Trending. Not just trending. Strong sell across every single time frame. Monthly, weekly, daily, 5-hour, 1 hour, all printing red candles, all aligned. ADX is above 45, which tells you this is not a drift. This is a momentum-driven route. The bias is short, fade rallies. Do not buy unless you have a very specific trap play. But there is one level that flips everything. Write this number down. If we break and close above 1.1440 on the 4-hour chart today, the entire bearish structure resets, and we are back into range-bound chop. That's the pivot, that's the line in the sand. And here's the micro insight about where the herd is positioned right now. Sentiment data shows the euro was already leaning weak before this survey hit, and now everyone's piling on the same side. That means if we do get a sudden spike toward 1.1440, a lot of stops are going to get run, and the short squeeze will be violent. That's your trap. Let's walk this chart from the top down, because the structure tells a story that most traders are completely misreading. Starting on the weekly. The 200-week moving average is sitting at 1.1598, and price is trading a full 2 big figures below that. That's a bearish regime. The weekly candle is a massive Maribozu at this point, no lower wick of significance, and it's chewing through supports that it held for months. The 50-week is at 1.1631, the 100-week at 1.1631 as well actually, almost a flat convergence zone way above us. That entire area is now heavy overhead supply. If we ever get back there, it's a sell zone on any time frame. But we are not there. We are down here, and the question is how much further this can run before gravity takes a pause. Now drop to the daily. This is where it gets really interesting. The daily chart shows 5 consecutive bearish candles, price accelerating away from the 20-day moving average at 1.1533 and the 50-day at 1.1598. That's a widening gap, which means momentum is strengthening, not fading. But the RSI on the daily is 27.8, deep into oversold territory. In a strong trend. RSI can stay oversold for a long time, so that alone is not a buy signal. But combine that with what's happening on the 4-hour, and you start to see the hidden divergence. Here's what most traders miss, and I need you to watch this carefully. On the 4-hour chart, price has made a new low below 1.1380, but MACD histogram has actually started making a higher low. That is a positive momentum divergence. It's not confirmed yet, it's subtle, but it's there. It means the energy behind the selling is getting exhausted. The 4-hour 20-period MA is at 1.1533, so very far away, but the 60-period MA is compressing down around 1.1480. So we've got a cascading structure of moving averages all pointing lower, acting as dynamic resistance. The 200 period on the 4H is at 1.1598 again. Notice that number keeps appearing. That's a magnet if we ever get a relief rally, but for now it's a ceiling. On the 60-minute, the story is pure short-term momentum. The 20 MA is at 1.1444, which coincides almost perfectly with today's pivot of 1.1440, and the 50 MA on the 1H is 1.1483, adding another layer of resistance. The 60-minute RSI is at 27, no signs of life. The 1-hour Williams %R is pinned at -98. It literally cannot go any lower. That means on the very smallest timeframes, we are at extreme oversold levels. When you see that, you either get a snapback bounce or a final panic flush. Which one happens depends entirely on what occurs around 1.1349 now, support and resistance levels with exact numbers. We already took out S1 at 1.1405 like it was butter. S2 at 1.1384 is where we are hovering right now, so that's already under pressure. The next meaningful floor is S3 at 1.1349. That is the level. Below that, there is a vacuum down to the 1.1300 handle, and then 1.1250 comes into play. On the upside, any bounce will immediately run into previous S1 at 1.1405, now flipped to resistance. Above that, R1 is 1.1461, and A2 is 1.1496. The pivot at 1.1440 is the midpoint gravity. So your battlefield is defined. 1.1349 below, 1.1440 above. Price between those two is just noise, but breaking either end triggers a cascade. I want you to notice one more thing, and this is where cross-asset linkage screams at you. Gold is moving tick for tick with real yields collapsing, but the dollar index is ripping higher, which means this euro to US dollar drop is not just a euro story. This is a dollar strength story. And that dollar strength is being fueled by a hawkish repricing of Fed expectations. The bond spread between 2-year UST and Bund has blown out again. That spread is a magnet for euro to US dollar. As long as that spread widens in favor of the dollar, euro rallies are to be sold. This is the dollar killers dynamic playing out in real time. Yesterday's shift wasn't some random headline. It was Barclays, a major institutional player, coming out and explicitly calling for a dollar rebound after the recent euro gains. That's a big deal because Barclays moves capital, not just words. They're signaling that the euro was already overextended, and the market needed a reason to sell. That reason came with this sentiment survey. The euro was already leaning lower before the data hit, and then the number printed weak, and the sell-off accelerated. That's the narrative web. It's not a singular event. It's a convergence of positioning, yield spreads, and macro repricing. Now let's talk about what's priced in. The market is currently pricing a Fed that's going to stay restrictive, while the ECB is being forced toward more dovish language. Policy divergence is widening again. And when policy divergence widens, euro to US dollar trends. It's that simple. The 1 to 2 week directional lean is continued downside pressure, but with a volatile trap possibility around 1.1349 to 1.1300. The exact event that would invalidate that bearish lean is a daily close above 1.1461. That's a 1, and if we close above there, the structure shifts back to neutral, and we have to respect a mean reversion move back toward 1.1600. But right now, that's not the base case. The base case is lower, with a liquidity grab in between. Here's your second interaction trigger. I want to see where the consensus is. Do you think the dollar index breaks 106 this week? Comment yes or no right now. I'm tracking what real traders believe, and that contrast between retail sentiment and institutional flow is often the trade itself. Most people skip this section. They watch the analysis, get the view, and then they don't translate it into a plan. That's exactly where the money is made. Keep watching, because I'm about to give you 3 specific blueprints with exact entry levels, exact stop losses, and risk-reward ratios. This is your playbook for the next 24 hours. Strategy 1. The sniper, conservative. The sniper doesn't chase. He waits for the trap to be set and then picks off the overextended move. Right now, the entire market is short, and we are hugging extremely oversold levels on all time frames. The conservative play is to wait for a relief rally into resistance and then short into that liquidity. Here's the exact trigger. If price retraces to 1.1405, which is the former S1 now flipped resistance, and we get a 1-hour candle close back below 1.1400, that is your entry. Alternatively, you can set a sell limit at 1.1405 with a stop loss at 1.1445, above the pivot and today's high probability turning zone. That gives you 40 pips of risk. Target 1 is 1.1349, the S3 level. That's 56 pips from entry, giving you a 1.4 to 1 reward to risk on the first target. Target 2 is 1.1300, the psychological level, for a total of 105 pips, about 2.6 to 1 reward to risk. What voids this setup? A 4-hour candle close above 1.1461. If that happens, the bearish structure is broken, and you do not want to be short. That's your invalidation line. The sniper, so of entry, 1.1405, sell limit or 1H close below 1.1400 after touch, stop loss, 1.1445 take profit 1, 1.1349 take profit 2, 1.1300 risk, reward, 1:2.6 invalidation, void if 4H. Candle closes above 1.1461 strategy 2, the active trader, standard. The active trader wants to ride the momentum but with a structured entry on a pullback, not a blind market order. Here we are going to use a mean reversion sell at the nearest intraday moving average that's acting as dynamic resistance. The 1-hour 20 MA is currently at 1.1444, but that's a bit far. A more precise standard play is to wait for a minor bounce to the 1.1384 to 1.1390 region, which is S2 now acting as near-term resistance, and enter on a bearish rejection there. Look for a 15-minute pin bar or engulfing candle. Set your stop loss at 1.1415, above the 1.1405 level, for 25 pips of risk. First target is 1.1349, which gives you about 35 pips, a 1.4 R. Second target is 1.1300, 484 pips, a 3.4 R. Once target 1 is hit, move your stop to break even and let the rest run with a trailing stop of 15 pips. This way, you're managing risk actively while giving the trade room to reach the second target. Invalidation. If price breaks and holds above 1.1405 for more than 30 minutes, you exit and wait for the sniper setup instead. The active trader, hard entry, 1.1388, limit on 15M bearish rejection, stop loss, 1.1415 take profit 1, 1.1349 take profit 2, 1.1300 risk, reward, 1:3.4 R trail, move SL to BE after TP1, then 15 pip trailing stop invalidation, void if price sustains above 1.1405 for 30 plus minute or right, quick pause. I want you to type your euro to US dollar range for tomorrow in the comments right now. Give me a high and a low. I'm going to track how closely the community aligns with the actual range, and you'll be surprised how often the collective read becomes a contrarian signal. Let's see who's aligned. Strategy 3, the aggressor, high risk. This is the counter-trend trap play. It's not for everyone. Only for those who can lose small and manage risk aggressively. The idea here is that the market is setting up a liquidity grab below 1.1349. The entire world will be watching that level, stops will pile up just beneath it, and then there's a high probability of a sharp snapback as those stops get run and buyers step in. The aggressive trade is to go long on a dip to exactly 1.1349 or a brief spike lower to 1.1335, with a very tight stop at 1.1315. That's just 20 to 34 pips depending on your fill. Your target is a rapid bounce back to 1.1405, the S1 flip resistance. That's 56 pips from 1.1349, giving a potential 2.8 R if filled perfectly. You can take partial at 1.1384 and let the rest run. This trade is a pure liquidity play. If it starts to work, get your stop to break even immediately. Invalidation is simple. If the 1-hour candle closes below 1.1315, you're wrong, and you get out. Do not hold a loser hoping. This is a one-shot, high-concentration entry. The market will either give you the pop or take your small stop to the aggressor, high risk entry, 1.1349, limit long, or 1.1335 spike, stop loss, 1.1315 take profit 1, 1.1384 take profit 2, 1.1405 risk, reward, 1:2.8 R, from 1.1349, invalidation, void if 1H. Candle closes below 1.1315. Here's the non-negotiable rule. And I say this every day because it's what keeps you alive. Never risk more than 1 to 2% of your account on any single trade. Do not hold positions through high-impact news events unless you're sized for the volatility. Stops are sacrosanct. You place them immediately upon entry and you honor them. This is how you survive to trade the next big move. The setups I just gave you only work if you execute with discipline. Emotional trading kills accounts. Precision saves them that if there's one level you stare at for the next session, it's 1.1349. That is the line. That is the floor. A sustained break below it opens a trapdoor to 1.1300 and 1.1250. A hold and bounce from it could ignite a 100 pip reversal. Watch the 1 hour close there, not the wick, the close. That's your tell. Tomorrow's wildcard is the next round of central bank speak and whether the bond spread continues to widen. We are also tracking a major divergence building in the S&P 500 versus Bitcoin that could signal a risk-off wave. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen. I break down where the liquidity is hiding in the ES and why BTC funding rates are flashing a caution signal. That's a separate deep dive, and it's critical for anyone trading risk assets. Smash the like button if this gave you a clear, tradable plan. Subscribe, hit the bell, and I'll see you in the next one. This is the Institutional Edge, delivered daily.